Nvidia is renowned as the architect of the world's most advanced AI infrastructure. Demand for their graphic processing units is at its peak as the capabilities of AI shift from simple chatbots to fully automated systems. Amazon, Meta, Microsoft, and Google are projected to collectively invest over $650 billion into capital expenditures. However, while the GPU market is poised to explode, the evolution of its competitive landscape has caused Nvidia to face heightened investor scrutiny. Underdog chipmaker Advanced Micro Devices has appeared to surpass Nvidia in terms of GPU capabilities on paper, and it's begun to secure major contracts. Meanwhile, tech giants aim to diversify away from Nvidia through developing their own chips. So this all begs the question, will Nvidia's stock have another rally? Or are they about to lose their crown? Nvidia recently released its results for the fourth quarter of fiscal year 2026, and they surpassed analyst expectations. Revenue grew 73% year over year to $68 billion. Absent one-time charges, Nvidia's net margin was 58%, while their EPS was $1.62. Assuming their guidance for quarter one of fiscal year 2027 is correct, Nvidia's revenue will grow 78%, and their EPS will climb to $1.78 according to non-GAAP principles. A slowdown can be observed since the peaks of 2025, but this is natural after a company's enterprise value skyrockets. Arguably, the most important figure in the earning report was Nvidia's Q1 guidance, and it's a clear indicator that they're going to still capture most of the accelerator demand. Advanced Micro Devices is another manufacturer of GPUs, and their focus shifted from gaming to AI like Nvidia's. The two chip makers introduced new generations to their GPUs on a yearly basis. Nvidia's 2025 architecture was the Blackwell chip, while AMD's was the MI355X. On paper, the MI355X seems superior. Its memory capacity is 288 GB compared to Blackwell's 192. Its FP4 and FP8 compute speeds are 10 and 5 pflops, greater than Blackwell's 9 and 4.5. But in the context of training AI models, chips don't perform individually, they work in clusters. Both chip makers developed their own network systems, but Nvidia's was far superior. Nvidia's NVLink could connect 72 GPUs, while AMD's Infinity Fabric hits a wall after 8 GPUs. Once the GPU count in a cluster surpasses 8, AMD has to rely on standard networking solutions to connect its GPUs, which significantly increases their latency. Nvidia and AMD have created software platforms which essentially enable developers to give instructions to their chips. However, Nvidia's Compute Unified Device Architecture software is far superior to AMD's Radeon Open Compute. CUDA was launched over a decade earlier and has become the industry standard. It provides a far more extensive library network and is usually the first AI software to support new models. One of CUDA's most powerful libraries is the Transformer engine. It can downshift the format of the chip's received data if a task can be successfully completed with a lower amount of precision, increasing calculation speed drastically. Broadcom is the leading manufacturer of application-specific integrated circuits. While GPUs have more flexibility and can serve multiple purposes, ASICs can be much cheaper to use for the task they're specifically designed for. Broadcom has a vast network of contracts, including ones with the hyperscalers making up the bulk of Nvidia's revenue. Around one half of Nvidia's revenue comes from smaller enterprises that wouldn't have the financial capability to develop their own cutting-edge chips, but the other half comes from hyperscalers. So Broadcom's emerging dominance is ultimately a valid concern. Google is one of Broadcom's largest partners, and they have worked together to develop the Tensor processing unit, with its latest generation being the Ironwood chip. Ironwood has a scale-out limit of 9,216. Its optical circuit switching networks use light instead of electricity to enable communication between chips. These factors make Ironwood far more efficient in terms of cost and electricity usage. Nvidia will likely retain their market dominance, as TPUs are tightly integrated within Google's system. They can only be rented through Google Cloud and are programmed through Google's JAX and TensorFlow frameworks. CUDA is the industry standard, while JAX and TensorFlow have a steep learning curve. A complete shift to TPUs means rewriting tons of CUDA code to suit Google's frameworks. This is a time-consuming obstacle, and in the rapidly evolving AI race, companies cannot afford to lose time. However, the TPU's greatest strength, its hyper-specialization, is also its biggest risk, and this applies to ASICs in general. Matrix multiplication, which is what TPUs are exclusively designed for, is currently the standard method used for AI calculations. However, more advanced methods such as liquid neural networks, which adapt their parameters to new data automatically, are being researched. Therefore, it's highly likely that the AI calculation standard will change within a decade. While GPUs are prepared for these kinds of changes due to their flexibility, ASICs risk obsolescence, especially if they are designed exclusively for one type of calculation. This applies not just to new AI models, but to entirely new technologies such as advanced drug modeling and edge computing. It's why Nvidia was the first to boom when AI chatbots emerged, as their chips could be used to run them from the start. Therefore, corporations are not fully eliminating Nvidia's GPUs from their chip stack, and it's a strategic decision to ensure they're prepared for future technological evolutions. Nvidia's EPS in fiscal year 2026 was $4.92 according to non-GAAP principles. Nvidia's 2026 EPS grew 65% from its 2025 EPS. Broader market tension could linger for some more time. Tariffs, temporary job displacement, and the potential closing of the Strait of Hormuz can all have short-term negative impacts on the US economy. Nvidia's stock went down to a PE of 30 amid tariff uncertainty in 2025. Therefore, I predict that the stock price could hit a low of $150 before beginning an ascent. Nvidia's PE at a price of 200 is currently 40. Nvidia historically trades at an average PE of 50, with the overall market trading closer to 25. As I discussed in the video, Nvidia's competition has evolved tremendously, but they are still growing the fastest out of all chip makers and are unlikely to lose their market dominance. If Nvidia's trailing 12 months EPS increases by 40% after 3 more earning reports, and they continue to trade at 40 times earnings, the stock price could hit $280 before the end of the calendar year. This growth estimate is reasonable and arguably conservative, as Nvidia's company growth will continue to be strongly correlated with growth of the overall AI semiconductor market, which is facing heightened demand. So, the verdict of this video is that Nvidia will have another rally. The road leading up to it may be bumpy, so I'd suggest waiting for a further improvement in Nvidia's PE before investing. In my opinion, Nvidia would be a screaming buy at $150 in terms of return over a 1-year time frame. Agentic systems need much more chips than ever, and companies are scrambling to get as much as they can. All chip makers will have more market share to acquire, and I think Nvidia will be among the ones to capture the most of it thanks to their wide economic moat and critical advantages. This video aimed to give you the actuality of Nvidia's situation. I provided you with the facts, so now you can make your own investment plan. Leave a like on the video if you enjoyed it, and subscribe to the channel if you want to see evaluations on more stocks in the future. I hope to see you in my next video. Thank you for watching.